Well, good morning, everybody, and thanks for joining us today. Welcome to the Hancock Gore Investor Conference Call. All attendees are now in listen-only mode. On the call today, we've got Hancock Gore Investment Directors Nick Atkinson and Joseph Constable. I'll pass you across in a moment to Joseph to kick off our discussion of the company's recent announcements, including the launch of a new fund. Today, we'll have a formal presentation followed by Q&A. If you'd like to ask a question during the call, please type it into the Q&A panel within the Zoom app. Alternatively, for anybody who's come dialed in using their phone, you can email any questions that you might have to tim@nwrcommunications.com.au and we can address them that way. So to kick things off, I'll hand across now to Hancock Gore Investment Director Joseph Constable. Go ahead, Joseph.
Thank you, Tim, and welcome everyone to the H&G High Conviction Fund webinar. I'm very excited for this launch, and I really appreciate you taking the time to be here this morning. So why did I invite you here today? I believe that the most balanced portfolios have exposure to microcaps, which have the potential to significantly outperform the general market. And when you have any, say, medical queries, you wouldn't spend your valuable time consulting Google, which would probably be guaranteed to tell you the most morbid of outcomes, but instead you'd consult a medical practitioner. Now, the same thing applies to investing in microcaps. As tempting as it may be to consult online stock forums like Hot Copper and make your own punts, I'm here to offer a fund where we conduct the most rigorous due diligence and make investments based on the extensive time, experience, and passion that we put into our research. So I'd love to spend the next 20 minutes or so explaining to you why I think this is an exciting opportunity that I'm sharing with you. And I'm also joined by my colleague, Nick Atkinson, who later on will expand on our investment approach. There'll be ample time for questions at the end, and the presentation is on the fund's website, so it can be perused in further detail at any time. So I'm going to begin with an overview of the fund and its track record, then discuss who we are, our investment strategy, current portfolio, and finally some case studies. So first is the disclaimer, and the important point to note is the fund is only open to wholesale investors. This is defined on our website, but in brief means if you have sufficient experience investing in securities or net income of, or gross income, of $250,000 each year, or net assets of $2.5 million. This is an overview of the fund, and the important points to note here are that our custodian, who holds all of the assets of the fund, is JP Morgan, and our auditors are Ernst & Young. There's a 1% management fee and a 1.05% cost cap to recover the operating expenses of the fund. Now, these operating expenses are generally fixed, so as our funds under management grows, the percentage recovered from the fund will reduce below 1.05%. The performance fee is 20% of the benchmark outperformance, with the benchmark being 5% per annum. We have a high watermark, which means if we go into the negative, we have to recoup the losses before we get a performance fee. As you can see, the fund has a 14-year track record of significantly outperforming the market. We've compared it here to the ASX Small Ords because that's the most relevant mainstream benchmark for us. It's also noted that this track record comprises that of the supervised fund, which was originally launched by Supervised Investments before being acquired by Hancock Gore in March this year. This strategy really remains the same still today, and as do the unit holders. There's also a crossover with the management team since I was with Supervised for the last 5 years. I'd also like to point out to you the drop in fund performance that you can see on the chart about 18 months ago. And this was mainly due to two of our biggest holdings, the first being Kangaroo Island Plantation Timbers, or KPT, where the share price halved following bushfires of 2019 to 20. And I'll go into that in further detail in a later slide. And the second was Hancock Gore itself. And this had been a long-term holding, and due to mismanagement saw a significant share price decline. Now, I joined the board of Hancock Gore in June last year and worked closely with fellow directors to help turn around the company's fortunes, including recapitalizing, restructuring, and appointing an executive chair. And pleasingly, the share price has gone from 11 cents to 23 over the period, and the fund no longer holds shares in the company as they've been distributed to the unit holders. So the H&G High Conviction Fund is managed by H&G Investment Management, which is a wholly owned subsidiary of Hancock Gore. And Hancock Gore is an ASX-listed $45 million market cap investment group with a 120-year history, making it one of the oldest ASX-listed companies. It was actually previously in the funds management business and actually provided the seed funding for Hunter Hall and MMC Contrarian. And after some years of a gap, earlier this year, Hancock Gore marked its re-entry into funds management with its acquisition of Supervised Investments, which has been renamed H&G Investment Management. It's a really considerable asset to the H&G High Conviction Fund, having the resources of a $45 million publicly listed company with $10 million in cash, no debt, and a really strong investment team. And I'm going to go into that team in a bit more detail now. So, as with any organization, our team is our greatest asset. The chairman of H&G Investment Management is Sandy Beard, and he's had an illustrious investment career, having spent almost 20 years at CVC, where he returned over 15% per annum to shareholders through investing in emerging and undervalued businesses. Sandy is also the executive chairman and a substantial shareholder of the parent company, Hancock Gore. And as you can see, he has considerable hands-on involvement as a director of multiple microcap ASX-listed companies. And it's extremely valuable to be able to draw on his extensive experience. Now, I'm the portfolio manager, and I got my first taste of funds management with the multi-billion pound UK asset manager, Smith & Williamson, and later Hunter Hall International. I've been with the investment manager for over 5 years now, and my real passion is doing just in-depth experience into companies and getting to the point where I feel like I know more about them than most others. And I feel my postgraduate studies in history quite helped to bring rigor to my research process, along with the wonderful mentorship I've received along the way. And I'll be describing more about the research process shortly. But happily, it seems to have worked so far, as my stock selection has returned 31% per annum since I first started. We're also fortunate that the fund is able to leverage off a very experienced and motivated team at the parent company, Hancock Gore. Now, Ian Thompson is our compliance manager, and he brings precision to our internal processes. And we have Nick Atkinson and Phil Christopher, who are the investment directors at Hancock Gore. And Nick was at Morgan Stockbroking for 14 years and was head of institutional equities, with Phil being at Alcyon and before that at Goldman Sachs. Now, both of them absolutely love doing deals, and given their networks and connections, are constantly receiving and analyzing them for Hancock Gore in a range of sectors. And this brings immense deal flow to the H&G High Conviction Fund, which has already benefited from co-investing with Hancock Gore. And as I mentioned, I've got Nick on the line, and he's going to go into a little more detail about this beneficial relationship between Hancock Gore and the fund. So we believe the H&G High Conviction Fund is a unique offering, which gives us an edge in the market. And the first reason for this is we're active investors. We build strong relationships with management, and where necessary, help implement strategic change, including joining the board. While not seeking to be activist investors per se, we're happy to roll up our sleeves if need be. And we're always searching for companies where others don't. And that's specifically in the microcap world. Now, this universe of emerging companies is a source of abundant under-researched businesses that, due to an absence of institutional ownership, can generally lack access to sufficient capital. But taking a meaningful position in any of these and assisting in reshaping them can drive significant performance uplift. But this is what truly allows us to feel confident that we're buying shares in a company where we feel we have a better understanding of it than most other investors. Because we're investing in the microcap world, and we don't want to end up with more than 20% ownership in any one company, we intend to keep funds under management below $50 million for the foreseeable future. And this is part of our conviction that small, concentrated funds can generate larger long-term returns. Finally, to find companies that are truly undervalued and have sufficient downside protection, we look for stocks where non-operational externalities, such as, say, fractious shareholders, domineering directors, government interference, or even industry pressures, have negatively impacted investor sentiment. Yet underlying all this is a superior business or asset. These outside influences generally lead to uncertainty and undervaluation, which gives us the opportunity to buy at an attractive price. Now, to speak about our deal flow in a bit more detail, I'm going to pass over to Nick Atkinson.
Thank you, Joseph. Yes, as mentioned, the HGL team has nearly over 70 years combined experience, which the H&G High Conviction Fund certainly leverages from. Just starting in the top right of that quadrant, the inbound deals, the team has multi-decades of experience, and it is a rich source of deal flow from my days in investment banking, stockbroking side, Sandy's days at CVC, Phil's side on private equity, definitely have very rich networks, and we believe we see a lot of deals. Moving to the bottom right, the team works very collaboratively together. As mentioned, we have over 70 years of experience in markets, and we are in constant dialogue during the day, have formal meetings weekly where we share ideas and ensure that we're driving into the best possible allocation of the capital. Moving to the bottom left quadrant, in-house research. We do, I would describe, forensic style research into the investments we look at. As Joseph mentioned, a lot of these companies in the fund aren't actually covered by brokers, so you don't have the luxury of referring to an analyst or a broker report, and it absolutely requires forensic analysis of not only financials, but certainly the competitive backdrop, what competitors are doing, what suppliers are doing, and what customers are doing. And again, we just leverage our professional networks there to get unique insights into the business. And as mentioned by Joseph, we believe we nearly get to a point where sometimes we actually know more about the business than the actual managing director of that business. And proprietary screening, again, just leveraging the networks that we have to ensure we are spending the optimal time in the right areas. Back to you, Joseph.
Thank you very much, Nick. I'm going to give a bit of an example in this simplified slide here of what our investment process actually looks like from, say, beginning to end. So before investing, the target company that we're looking at would tend to be under $100 million market cap in size. It's overlooked by institutions and undercapitalized, and generally trading at a discount to its inherent value. We would then invest as part of a reinvigoration or change in strategy, whether that's the company introducing new management or board, pursuing M&A, or simply recapitalizing. And any of these catalysts can lead to a market re-rating. And that results in the invested company finally coming onto the radar of institutions and then beginning to trade at closer to its inherent value. And we are able to be a beneficiary of that uplift. Now I'll go into more detail on our investment approach. So our research is what you describe as bottom up. We start with the details and do intensive research to determine what the company is or could be worth. And if this is sufficiently greater than its share price, and I just mentioned trading at a discount to its inherent value, we'll then be interested enough to assess the ownership structure of the company. We ask, is it run by a passionate person who has a meaningful shareholding? And if so, we then will research the industry and the macro environment to see if there are any red flags and maybe headwinds that will be preventing the company from flourishing in the near term. And then if it passes through this, we go and meet with the management. And this is probably the most critical step, since we feel we really have to have an alignment with management and just as much know they're receptive to us and don't mind us calling them all day and all night to discuss the company or macro environment. And generally, by the time we invest, we've been in extensive dialogue with management and have witnessed firsthand that they really deliver and stick to their word. I should also note we're very mindful of not trading with any non-public price-sensitive information. We then also speak to suppliers, customers, and competitors. And this is an important step as it gives greater and generally, you'd say, non-biased insights into the company and its reputation. Now, there's one thing being cheap, but a company must have identifiable catalysts that will help unlock its inherent value in the medium term. This might be the sale or acquisition of an asset, new board or management, or maybe even just better engagement with the market. And to this end, we're always looking beyond the most recent set of financial results, and often actually disappointing results caused by a temporary macro setback can lead to a good entry point. And COVID is obviously a great case in point. Finally, we take an active approach with our holdings, and we regularly speak with the board and management of our investee companies, and where necessary, engage in implementing strategic change. And this is possible because we're investing in this microcap space, and we have a very concentrated portfolio, so we can stay on top of each holding. Now, here are some of our objectives, and if you follow with me along through the hexagons, I'll start on the top left. And first is we're targeting a return of 15% per annum for our unit holders. Now, view is if you're going to be investing in the riskier end of the market in microcaps, you need to be targeting this kind of return. We take a long-term outlook and approach as investors, and definitely not traders. We also take an active approach when necessary, as I've mentioned, and are really looking for long-term outperformance by investing in stocks which we can hold for many years and enjoy the benefit of compound returns. Now, to that end, we hold ourselves to the highest standard of due diligence and risk management, so we feel comfortable our investee companies have adequate downside protection. Now, I'll tell you more about alignment in the next slide, but in brief, for a concentrated fund like ours, we believe it's crucial for the managers and the unit holders to be wholly aligned. And this is aided by our performance-based remuneration and our personal investments in the fund. Finally, we're also passionate about supporting emerging dynamic Australian businesses. And this is what really gets us excited about our work each day. It's that personal touch and experience with these companies. And we have a particular focus on businesses that have a favorable impact on society from an ESG perspective. I just mentioned alignment, and I want to emphasize this a bit because it really is a crucial point for us. So 36% of the fund's units are held by my immediate family, and we're wholly focused on preserving capital. We're not simply looking to make a quick performance fee. It's a 10+ year investment strategy always. And to that end, our core business is investing in companies with very conservative balance sheets that can withstand the worst case scenario stress tests. And we tend not to invest in businesses where shareholders' claim over the net assets is less than 50%. And as mentioned earlier, we don't borrow to leverage on any of our holdings. Now, this is our portfolio as it currently stands. The top 7 positions in this table show the percentage of capital used to purchase them and the current weighting, which includes share price appreciation. As evident, we have several high conviction holdings, and all but the bottom position, which is Comms Group, have actually been in the portfolio for over 18 months, and the top 3 for over 5 years. And the pie chart on the right shows our breakdown by sector. And as you can see, we're fairly well diversified. I'm now going to take you through some recent drivers of the fund's performance and expected future contributors to give you a bit of flavor of the kind of investments the fund makes. The first is Centrepoint Alliance, ticker CAF. It's a company we still hold stock in. Centrepoint is one of the larger financial advisory groups in Australia with a great reputation. But following the Royal Commission into Financial Services, the business was hit by a number of one-off advice claims and was also forced to change its business model to no longer be reliant on commissions. And during this period, they temporarily became loss-making. And as a result, the stock fell quite dramatically, as you can see in the chart, from about 70 cents to 10 cents, as many and most institutions sold out. So we believe there was still considerable value in the company, considering it had this superior group of high-rated advisors. So we did the work, we engaged with management, and felt comfortable in their capacity to shift to a fee-based revenue model instead of commissions. And they have indeed been very successful in pivoting to this new model, and which, along with the resumption of dividends, has returned us up 181% in under 2 years. And it's also worth noting that Sandy Beard is a director and has been instrumental in the company's turnaround. So as you can see, 6% of the fund is still held in Centrepoint. Now, to give a balanced view, I'd also like to talk about a detractor to recent performance and give an example of how we can constructively engage with the board and management to help the company achieve its strategic goals. Po Valley Energy has been a very long-term holding for the fund, and over that period has actually been a positive contributor. It owns gas fields in northern Italy that have been drilled, they have proven reserves, and actually really close to existing gas pipe infrastructure. They're awaiting just their final production concession for gas starts next year. And the net present value of these gas fields are worth multiples of the present share price. However, Italian politics, which you may or may not know, and also COVID-induced lockdowns led to the company receiving its environmental permits a bit later than expected. And this led to the share price declining by 17% over the last year. The company therefore had to raise money to fund its operations. And given we're interacting with brokers most days, as Nick said before, we introduced them to some brokers whom we've worked closely with, called Henslow. And they successfully raised $11 million, which was an enormous achievement, increasing the company's market cap by 50% and rendering it fully funded until gas production commences. So we now believe PVE is in an excellent position with a really strong balance sheet, significant upcoming catalysts later this year when they should receive their final production permits. In the meantime, natural gas prices have risen to multi-year highs, making PVE's assets highly strategic, and also the political situation in Italy has dramatically improved. Finally, I'll discuss the fund's largest holding, and that is Kangaroo Island Plantation Timbers, or KPT, which I mentioned earlier. We have held stock in KPT for many years and have benefited from the company's acquisition of most of Kangaroo Island's forestry plantations, which has resulted in amassing a land holding of 20,000 hectares. Our average purchase price for the fund is about 62 cents compared to the current price of $1.21. So it's been a positive holding, but in the disastrous bushfires of 2019 to 20, 90% of the company's plantations were destroyed. And as you can see, that led to a very large share price fall in early 2020, which led to the company trading at significantly below its net tangible asset backing. But we believe the stock still trades at a considerable discount to a conservative estimate of its asset backing, which is, I'll go into in the next slide, mainly cash and land. And following the bushfires, we engaged extensively with management and other shareholders. We visited the island and spoke with the locals and came to the conclusion that the best way forward was to remediate the plantations and sell them off as agricultural land. To this end, in July this year, the board changed and the company announced it intended to change its strategy from a timber producer to revert all of its forests to farmland and start buying back stock. Now, we're very optimistic of the future and are happy with our holding in KPT at 17% of the fund. Now, just for a little more color, I've outlined here our assessment of KPT's inherent value. And in that table at the top, you can see its assets are extremely tangible and the company has no debt. So it's a classic case of something that we feel very comfortable with. The chart below that shows the appreciation of South Australian agricultural property over the last 5 years, which, like most of Australia, has experienced an amazing boom. And I've also included a map to show Kangaroo Island in context and show you just how large it is. In fact, it's the 3rd largest island of Australia. So we intend to continue working with fellow shareholders and the board to ensure that the company unlocks its inherent value, which is still fairly well above the current share price. We think at least 37%, which should produce for us a return of 17% per annum and contribute well to the fund's return. So on that note, I want to thank you very much for listening, and would appreciate any questions you have, either now or by email, or alternatively, feel free to call me anytime. And you can also check out our website for any more information.
Thanks, Joseph, and thanks, Nick, for the introduction to the fund and that insight into your underlying investments. That was a great summary. Thanks very much also to all of our attendees who have been lodging questions for the company. So let's jump straight into them. Joseph, what's your macroeconomic outlook and how is this impacting your investment decisions?
Yeah, I believe the global economy should continue to improve as COVID vaccinations are rolled out and borders reopen. But I also believe that inflation is truly here. And we're seeing this in increased commodity and shipping prices, as well as increasingly in wages. And I think that central bankers around the world are going to have to play a very delicate game of gradually unwinding asset purchasing and also gradually increase interest rates. And of course, this will put pressure on equity markets, but we're actually coming off such a low base of interest rates that I think it will be a while until individuals can start living off interest from the bank or government bonds. So I would think that equities should continue to experience these large inflows, which for 2021, for the first half of the year, experienced record ETF inflows, pretty much the same amount as the previous year, which was a new record. But looking at our portfolio, we're generally very stock specific in our investing, and so less correlated to the overall market. We are holding 19% in cash because we want to have ample firepower for when valuations inevitably decrease. And some of the stocks on our watch list, that on our wish list, I should say, that will become more attractive from a share price perspective.
Thanks, Joseph. And here's an interesting question about the fund structure and your modus operandi. Do you ever run into conflicts buying or selling joint investments with the parent company, Hancock Gore Limited?
Well, we actually have a formalized intra-company share trading policy, where if both the fund and Hancock Gore are going to invest in the same ASX company, we'll buy or sell together as one, and then split it pro rata according to the demand of each entity. So in that sense, because it's very formalized, as I say, that avoids any potential conflict.
Very good. And I guess diving in more specifically with an example, the questions come in noting that HGL Limited is a shareholder of FOSS Capital, which is also ASX listed. The comments made that FOSS looks undervalued, and the question is that an example of the sort of company into which the fund might be looking to invest?
Yeah, definitely, and that's a really good example of how, as Nick was alluding to before, there's great leverage of both of those, because HGL or Hancock Gore is doing its own research and investing into these companies, or some of its private equity holdings will end up becoming listed, like with FOSS Capital, and it's a great opportunity for the fund to do it. And as I mentioned before, we always have to be careful we're investing without any non-public information. So it's always a matter of, can we invest at any time if there's no information we know. But it's definitely a very interesting company and something that we could invest in.
And just adding to that, we are under escrow, and it's a great example where the group took a investee company and added value to it and managed to do a very strategic merger with FOSS Capital in this instance, to get liquidity. And we are continuing to be supportive of that company and can see a lot more organic and inorganic growth opportunities into the future. So we think this is just the start, and we absolutely agree. We think it's tremendously undervalued. And again, we've got 3 or 4 more of these type of investments in our stable that are at various stages and advanced stages to get liquidity per the FOS Capital example.
Yeah, it's a good example, Nick. And I mean, the proof is in the share price experience for FOS, having recently floated, and there's been an uplift for everybody in there in the last sort of 2 to 3 months. So would you agree that that's would that be a typical sort of, I guess, part of the game plan as far as looking to potential private investments for the fund or for the organisation generally to make with a view towards running towards IPO?
It's always, sorry, Joseph, do you want me to take that one?
Yeah, for sure.
Yeah, we always have a clear eye on exit plans and liquidity. And when I use the word exit plans, it doesn't mean we're exiting, we're just looking for liquidity. We have scenarios where there's trade sale opportunities, and in this instance where there was a great listed opportunity. So, and again, I think what sometimes gets missed, and hopefully it's coming across clearly in this presentation, is that investors in the H&G High Conviction Fund under Joseph's management actually get first look at some of these opportunities, perhaps before they go to the market. And you're seeing a strong proliferation of small cap managers in Australia pushing down into the, say, pre-IPO side of the market, and investors in the High Conviction Fund certainly benefit from that deal flow, as we mentioned earlier.
Yeah, it's a real value add for wholesale investors getting those sorts of looks, so that's good for people to be aware of. Just a reminder for attendees, just please lodge your questions in the Q&A panel if you've got them, and now's our opportunity to discuss. So the next one that's come through, Joseph, which stocks in your portfolio do you believe have the highest upside?
Well, naturally, there's every stock that we own, I feel, has significant upside, otherwise we wouldn't be holding it. But there's probably one in particular that I feel very much has a kind of almost unlimited amounts of upside, and this is a company called Hillgrove Resources. Ticker is HGO. It's our 5th largest holding, and it represents 5% of the fund, and it's a copper miner. And I'm not sure how many people have been reading in the news about how crucial metal copper really is in this electric revolution that we're undergoing globally. But there's the expectation that we have is that price, the copper price, is going to continue to rise over the next decade, and it's a very strategic mineral. And Hillgrove, this company, is a unique mine in Australia. It's an hour's drive from Adelaide, which is very rare. And it also is most likely going to be the next copper mine to actually commence production. They have everything in place. It's permits, processing plant, all the infrastructure. And that's because up until a year ago, they were actually mining and producing copper from an open pit. But for the last 12 months, they've been drilling to assess the sort of economics of underground mining. And they've intercepted some really significant amounts of copper so far. So they should start producing next year, and they're aiming for about 20,000 tons of copper each year. And to put that into context, that should generate revenues of about $300 million a year, compared to the market cap at the moment of 70 million. And they actually also have tenements of 565,000 hectares. So it's an enormous amount for them to continue drilling and expanding their resource. So that has, I would say, multi potential for upside. And we're very happy with that as 5% of the fund.
Yeah, there's real asymmetric upside there, Joseph, by the look of things, and it looks like the market's starting to cotton on, given I note HGO's shares have started to move in the last few days, so that's certainly one for all of us to watch.
Very
That concludes the questions that have come in for us now. So I think maybe we'll let people carry on from here and draw a line under it. So on behalf of Hancock and Gore, I'd really like to thank everyone for tuning in. We appreciate everyone joining us and for your continued interest in Hancock and Gore Limited and in the the High Conviction Fund. So I might pass across to you, Joseph, now for any closing comments.
Thanks, Tim. Yeah, so further to what Tim said, I really appreciate the time. Thank you very much for listening. I enjoyed sharing this with you, and please get in touch. My contact details are up on these slides. So anytime you want to learn more about the fund, I'd be more than happy to discuss it with you.
Very good. Thanks, everyone. We'll catch you next time. Cheers.
Thanks for the opportunity.
Thanks.